Bank of America paid $33 million in penalties to make this suit go away.
Banks got bailed out! We got sold out! Banks got bailed out! We got sold out!
Financial Industry Regulatory Authority has fined Bank of America's Merrill Lynch $500,000 on Wednesday for failing to give sales charge discounts to customers on unit investment trust purchases that were eligible.
As anti-Wall Street demonstrations continued all around the world, one target of the protesters' anger got hit with a heavy fine today. Citigroup will pay $285 million to settle a civil fraud case.
In our fourth story in the countdown, what we do know now is that in the years leading up to that meltdown, the top cops on Wall Street routinely destroyed information on promising cases. That in an investigation published in the new Rolling Stone by Matt Taibbi, who will join us momentarily. His piece also details a revolving door of friendly executives who moved from leadership of the SEC to top jobs in firms they had recently regulated. The Inspector General of the SEC is supposed to issue his own report on the coziness. A Senate committee is looking into it. Matt beat them to it. Federal and state prosecutors have yet to put a single senior Wall Street executive behind bars for any of the many well-documented crimes related to the financial crisis. Top federal regulators spend more time lunching, schmoozing, and job interviewing with Wall Street crooks than they do catching them. Need any historical evidence of that? Who repeatedly graded the investment house of Bernie Madoff Snow White? The SEC.
Banks got bailed out! We got sold out! Banks got bailed out! We got sold out!
Of course, my distress and sadness pale in comparison to the losses and hardships that customers, farmers and ranchers and others, employees and investors have suffered. Their plight weighs on my mind every day. As the Chief Executive Officer of MF Global at the time of its bankruptcy, I truly apologize to all those affected.
Sold out! Banks got bailed out! We got sold out! Banks got bailed out!
You got sold out!
Banks got bailed out!
You got sold out!
I decided to come down and join Occupy Wall Street because I am fed up with what the banks are getting away with. And trust me, I know what they're getting away with. I'm the CEO of Goldman Sachs.
This morning in the business world, Goldman Sachs has agreed to pay a record £350 million fine to the US authorities over the way it created and sold an investment fund made up of subprime mortgage debt.
Goldman Sachs will pay $550 million and reform its business practices in order to settle its SEC charges. The fine is also the largest penalty ever assessed against a financial services firm in the history of the SEC.
Cops they have here. Why are there so many cops here? Because the man inside owns billions of dollars. It's testament to the police are here to represent and to protect the 1%, not the populace.
The Financial Industry Regulatory Authority announced it has fined Wells Fargo Investments $2 million for unsuitable sales of reverse convertible securities through one broker to 21 customers, and for failing to provide sales charge discounts on unit investment trust transactions to eligible customers.
Zombie bankers stalking the globe. Unelected, they come to terrorize your country all over Europe.
Unelected bankers have been put into power in Italy and in Greece this past week.
They're the numbers the Federal Reserve said were too dangerous. Numbers that for the first time reveal the staggering sums the world's biggest banks borrowed from the Fed during the credit crisis. To get these numbers, Bloomberg fought the Fed all the way to the Supreme Court. Then we spent months crunching 29,000 pages of data and deciphering 18 giant spreadsheets. Here's what the Fed didn't want you to know. From August 2007 to April 2010, the central bank put $1.2 trillion of public money at risk in secret loans to financial institutions, almost 400 companies, some of them controlled by foreign governments.
Zombie bankers stalking the globe. Unelected, they come to terrorize your country.
In our name. One of those promises was made in 2003 when President George W. Bush signed into law something called the Service Members Civil Relief Act. Among its provisions, it told mortgage companies that if a mortgage company wanted to foreclose on the home of a service member who was on active duty, that mortgage company had to do some special precautions. They had to follow some special procedures, like, say, not using a default judgment to steal somebody's house out from under them just because they didn't show up for a court hearing about it. Because maybe it was hard to be at that court hearing in Pittsburgh while at the same time being in a foxhole in Fallujah. But as reported in the Financial Times this week, a watchdog at the Treasury has just reported that mortgage companies have basically been doing just that, illegally foreclosing on the houses of more than 5,000 active duty members of the U.S. military. The banks say they are looking into it, but so far the estimates are that Bank of America may have illegally taken the homes of more than 2,000 active duty U.S. soldiers, Wells Fargo nearly 900, Citigroup 700, and the list goes on. These are just the 10 largest. We have posted a list of them at mattoblog.com today if you want to check it out.
Your history doesn't. I was in Iraq with you. So why do you allow this? Why are they walking around trying to hurt people?
Let's go, folks.
Keep walking.
Please, I'm asking a nice minute to walk down the block, please.
And I can't speak. Y'all want to shut me up. Y'all want to shut me up.
Standard & Poor's has downgraded the credit ratings of the 6 biggest banks in the U.S. J.P. Morgan Chase, Goldman Sachs, Bank of America, Morgan Stanley, Citigroup, and Wells Fargo. This after the rating service rolled out new criteria on how financial institutions manage funds during times of economic stress. Downgrades likely mean higher borrowing costs for banks as customers will demand higher interest rates for assuming more risk.
J.P. Morgan Chase has been fined $2 million by the Office of the Comptroller of the Currency in regards to the marketing of credit protection products sold through the bank's auto, home lending, and car services division.
JP Morgan has been fined £33.3 million, approximately $49 million, by the UK's Financial Services Authority for putting its clients' money at risk by failing to keep it in a, quote, properly segregated bank account. JP Morgan was ordered to pay $35 million to settle allegations in a big rigging case. The Office of the Comptroller of the Currency said employees participated in a bid rigging scheme from 1999 through 2005. A judge in New York Federal Bankruptcy Court approved a settlement between the Lehman Brothers brokerage and J.P. Morgan Chase, in which J.P. Morgan will pay $861 million to the liquidating brokerage dealer. Judge James Peck signed off on the settlement, the largest yet reached by James W. Giddens, the trustee winding down Lehman's American brokerage unit. Peck commented on the situation, quote, "I'm satisfied that this is indeed an excellent result of the complicated settlement. This is obviously a very substantial step forward of the LBI liquidation."
Rolling Stone, good to see you, sir.
Good to see you, Keith.
What is the evidence that the SEC has been destroying evidence?
Well, the SEC has several levels of investigations. Basically, any preliminary inquiry is what they call a MUI, a matter under inquiry. And a MUI is just any investigation that's before the level of a formal inquiry.
Right.
And what they've been doing, dating back to 1993, is they've been destroying the records of any MUI that has not proceeded to a full investigation. So all these preliminary investigations of Bernie Madoff, AIG, Goldman Sachs, Citigroup, Lehman Brothers, as many as 18,000 cases, the evidence for all of them has been destroyed.
Sold out! We got sold out! We got sold out!
And the craziest ones were these two housewives that will... wives of Morgan Stanley executives, Christy Mack, who's the wife of John Mack, who at the time was the CEO of Morgan Stanley, and her and Susan Karchis got a $220 million TALF loan to invest in student loans and commercial mortgages.
Local level, we can make differences. A whole continent-wide cannot control a federal government with a banking system that prints money like it's paper. You can't even call it money anymore. Gold is money. Silver is money. Green dollars are not money.
The potential answer to the question, what has Occupy actually done? A federal judge today throwing out a cozy $285 million slap on the wrist against Citigroup by the Securities and Exchange Commission because the bank was not forced to admit to any wrongdoing nor even to divulge exactly what it did. Judge Jed Rakoff writing that SEC policy that of allowing banks to settle rather than disclose details, quote, asks the court to employ its power and assert its authority when it does not know the facts, and that an application of judicial power that does not rest on facts is worse than mindless. It is inherently dangerous. In the case, Citigroup was charged with negligence in selling investments to customers in a billion-dollar mortgage securities fund, which it later bet against. Investors reportedly lost $700 million, while Citigroup made about $160 million in profit.
All right, take it easy on there. All right. The world is watching. The world is watching. The world is watching. The world is watching. All right, take it easy on there. All right. The world is watching. The world is watching. The world is watching. The world is watching.
On Wednesday, the Federal Reserve hit Wells Fargo with an $85 million fine for supposedly steering borrowers into high-cost subprime mortgage loans, even if they were qualified for safer loans.
All right. The world is watching. The world is watching.
Britain's financial regulator has fined HSBC a record €12.25 million for mis-selling investment plans to elderly customers. The products were intended to cover the cost of staying in retirement homes, but were unsuitable because of the advanced age of most of those who bought them. Europe's biggest bank is likely to pay another €34 million in compensation to those customers.
There may well have been a combination of the two. There's no question that they dismantled a lot of the safety mechanisms that have protected our markets for a long time. But, you know, we're also looking at the conduct of individual institutions and individuals to see if there were misrepresentations made, to see if there was any fraud committed, to see if criminal acts were also a part of this. And that's what Bo and I are looking at, and we're determined to follow it through until we can get that relief that the homeowners need and hold accountable the people who caused this.
According to the Securities and Exchange Commission, 6 former execs will face charges for securities fraud and making misleading statements.
Securities and Exchange Commission wants them to pay financial penalties. Freddie Mac, Fannie Mae play a major role in the housing market. They also got the biggest bailout during the financial crisis.
The news was allegedly broken by Peter Barnes from the Fox Business Network. He says the charges basically state not only did the company expose itself to bad subprime mortgages, but they reportedly lied so they could acquire more.
This is the first comprehensive lawsuit seeking to attain accountability and real relief for the bank's role and their misconduct in the foreclosure crisis. This suit seeks accountability against the banks for both cutting corners and also rushing to unnecessarily foreclose homeowners without following the rule of law. That bank conduct includes, and this is in the more than 60-page complaint that we filed, but in summary, that complaint includes allegations about wide and fraudulent use of false documentation in the bank's rush to foreclose on homeowners, commonly known or called robo-signing. Secondly, the suit alleges bank conduct of unlawful foreclosures in which banks began foreclosures without actually holding the mortgage.
They continue to behave in ways that affect individual consumers, that affect the economy, and frankly, we think enough is enough. They've been the ones bailed out. They are still behaving in ways that badly affect not only individual consumers but the whole economy. And we believe that without real affordability for loan modifications and accountability by the banks, we're not going to solve this foreclosure crisis and we're not going to get our economy turned around. Even if the banks think they are too big to fail, they are indicating to us that they think they're too big to care about the devastation they're creating every single day. And we believe that they're not too big to have to follow the law.